Warren Buffett is the fourth richest person in the world, worth over $72 billion, has a sterling image based on his investing returns, and has a friendly approach to shareholders and management. This compares to other investors like Carl Icahn, who is known as a corporate raider because he initiates hostile takeover of companies, bending management to his will. Buffett has spent years cultivating this warm, bubbly image and has had a consistent investment philosophy in which he says he looks for businesses with favorable and durable economic characteristics, with good returns on tangible assets, and at sensible prices. He likes to say his favorite holding period for an investment is forever, and he scorns the use of too much leverage. However, there was a time when Buffett was a corporate raider, there was a time when he bought businesses with no durable competitive advantages, and finally there was a time when he used a lot of leverage. This video will go through that time. Hey guys, if you like this type of video, please hit the like button and subscribe. We run this channel and a website, themarketisopen.com, where you can view stock quotes and build your portfolio and upvote and downvote posts. We also run a second channel, TMIO Tesla. Warren Buffett was born on August 30th, 1930 in Omaha, Nebraska. His dad, Howard Buffett, was fittingly a stockbroker. Young Buffett loved mental math, and at age 10, he told a friend that he would be a millionaire by age 35 based on his calculation of how he was compounding his money, though at age 10, he had a mere $120. Throughout his teen years, he worked hard to accumulate money by delivering newspapers and investing. For example, at age 15, he bought a 40-acre farm for $1,200, and by the time he finished high school, he was worth $5,000, which is equivalent to $60,000 today. In his high school graduation yearbook, he fittingly wrote that he would be a future stockbroker. He then graduated university in 1949 with a business degree, but Buffett's early trading philosophy involved the voodoo magic of looking at charts.
And I took all the books I could out of there on markets, and I used a chart and do all that sort of thing. And then finally I read Graham's book when I was at the University of Nebraska, The Intelligent Investor, when I was 19, and that just changed my whole framework.
Graham's book instilled three key principles in 19-year-old Buffett. 1. A company was not worth a price just because the market says so. 2. When purchasing a stock, ensure you understand the downside risks. How Buffett calculated downside risk will soon be discussed. Finally, Graham felt it was important to think of yourself as a business owner when buying a stock. After reading his book, Buffett applied to Columbia University, where Ben Graham taught. He got an A+ in Graham's course and actively followed Graham to learn more about his strategies. He learned that Graham was the chairman of a firm called Government Employees Insurance Company, or GEICO for short. This company had a profound impact, and Buffett later called it his first love. Buffett tried to deduce what Graham liked about GEICO, so he traveled to GEICO's headquarters in an unannounced visit to ask some questions. Luckily for him, future GEICO CEO Lorimer Davidson was in his office on a Saturday and agreed to answer his questions. This event has gone down in history, as Buffett's knowledge of the insurance industry has been critical to the success of his company Berkshire Hathaway, a company that he has controlled since 1965. In his 2019 annual report, he says, "Our property and casualty insurance business has been the engine propelling Berkshire growth since 1967. Inspired by this 1951 conversation, Buffett put 70% of his portfolio, or $10,000, into this one stock. But ironically, Ben Graham would never put 70% of his portfolio in one stock, as he argued for extreme diversification. However, even young Warren Buffett had his own ideas, and he never liked to diversify.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
After purchasing GEICO, he wrote an article called "The Security I Like Best." He highlighted in this article GEICO's cheap valuation, based on it trading at only 8 times profit, and he noted its strong growth. After graduating in 1951, he had hoped to work for Graham, but was turned down, and Buffett begrudgingly went back to Nebraska to work for his dad's stockbroking firm, though he wasn't a great stockbroker, as he almost was never able to complete sales to clients. Where Buffett did have success was in the stock market, and his Geico stock increased 50% by the end of 1951, and he ended 1951 with a net worth of $20,000. Buffett likes to say during this time that he had more ideas than money. So he had a new idea, Western Insurance Company, and he dumped Geico stock. He again wrote an article called The Security I Like Best, and he noted Western Insurance should earn close to $25 a share, and he said the company traded at a 55% discount to its $86 book value, or approximately $47 a share. This investment helped his wealth approach $30,000 before a big event in August 1954. In August 1954, Buffett's hero Ben Graham hired him to work for his firm, Graham-Newman, in New York. Buffett learned that Graham practiced what he preached. Graham was extremely diversified, owning hundreds of investments. In addition, Graham made his employees fill out checklists to ensure each investment met his firm's criteria. Graham-Newman wanted cheap stocks that often traded below book value, and sometimes the firm had an even more stringent valuation criteria called net current asset value. Book value can be figured out by simply looking at a company's equity, and equity is what shareholders have left, assuming the assets properly reflect the actual value. But net current asset value takes only a firm's current assets and minuses out all liabilities, which is a very strict measure. Essentially, the logic is current assets are more easily able to quickly convert to cash, while fixed assets may be harder. So this technique produces a bare minimum valuation on a company. Graham also recommended putting some of your portfolio in arbitrage situations. Buffett excelled in arbitrage and became the firm's star trader. In order to analyze young Buffett, this series will look at 5 key trades that contributed the most to his success. The first trade was an arbitrage situation called Rockwood & Company. Rockwood operated in Brooklyn, New York, and Buffett saw a unique arbitrage opportunity as the price of cocoa beans shot up from 5 cents to 60 cents. Rockwood had over 13 million pounds of beans, meaning inventory previously worth $650,000 was now worth $7.8 million, and Rockwood's management sought a way to recognize this value. Its decision was to liquidate 13 million pounds of inventory at the 60 cent per pound price. The management used a unique transaction where it would repurchase stock for 80 pounds of cocoa beans. Therefore, a trader could get 80 pounds of cocoa beans at 60 cents per pound for each share he owned. Though, to be clear, the trader did not have to actually physically pick up the cocoa beans. The beans would be stored in a warehouse, and the trader would receive a certificate showing he owned the right to pick up those 80 pounds of beans. The arbitrage opportunity arose because the stock traded at approximately $44 a share, which was below the value of the 80 pounds of beans converted. Graham-Newman figured it could make an easy $4 of profit by buying the stock at $44, then selling the beans that were currently worth $48. However, there was a risk. What would happen if the price of cocoa went back to 5 cents? Then the stock's value would conceivably drop to $4. To protect the firm, Graham-Newman sold cocoa futures. This technique is often called shorting in stock market jargon. To keep it simple, it means you make money when an asset drops in value. So Graham-Newman would make money if the price of cocoa fell in value. Graham-Newman shorted 80 pounds of cocoa futures at 60 cents. So if the price of cocoa dropped back to 5 cents, then they would make $44 in profit on each contract. Here is why. Remember, they shorted cocoa futures at 60 cents and received $48. If the price dropped to 5 cents, the value would now be $4 for a profit of $44. But they also bought the stock at $44, which would now be worth $4, which is a loss of $40. If you net the two together, the profit would be $4. The $4 profit is also guaranteed even if the inverse happened and the price of cocoa rose. While Buffett executed the arbitrage trade for the firm, he wanted a bigger dessert for himself. Here was his thinking. The stock should be worth more than just its inventory value. As before this special transaction, Rockwood traded at $15 a share and had 162,500 shares for a value of $2.4 million. Buffett thought what would happen after management rebought its stock and he didn't sell his own stock. For example, say 60% of shareholders redeemed their stock for cocoa beans, and Buffett did not redeem his shares. Then the number of shares outstanding would drop from 162,500 to 65,000. However, remaining shareholders would still own 65,000 shares and 5.2 million pounds of cocoa. Buffett surmised the new value for the remaining shareholders should be the remaining inventory plus the value beforehand, or 5.5 million, or $85 a share. Buffett ended up being right. The 222 shares he bought at $44 were soon able to be sold at approximately $85, making him $10,000 in a very short time period. While this is an impressive return, Buffett did take on substantial risk. Had he followed Rockwood over time, he would have seen that the company eventually went bankrupt in 1967. Buffett later would learn this rule.
Lousy business, and that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding and keeps doing more business and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit.
So, had the market not revalued Rockwood higher, or if the price of cocoa collapsed, Buffett did risk some financial harm. Buffett made another quick $20,000, helping him finish 1955 with $60,000 of net worth. He noticed a company called Union Street Railway had $106.50 of cash per share, but half the cash was hidden in two accounts called special deposits and accrued interest. Buffett bought the stock for Graham-Newman and himself at $30. Then he used the power of his firm to pressure management to rebuy stock at $50. His $30,000 investment quickly turned into $50,000. Because of Buffett's excellent trades, Ben Graham offered Buffett the opportunity to take over his firm, as he, at age 62, was losing interest in the stock market. Buffett declined the offer as he joined the firm to work for Graham, and in early 1956, Buffett once again traveled home from New York to Omaha, Nebraska, but this time he would work for himself by starting Buffett Partnership Limited, or BPL. On May 1st, 1956, at 25, he raised $105,100 from family, friends, and himself. But Buffett only contributed a mere $100. The reasoning has to do with the levered structure of his partnership, which is odd for someone who constantly says this.
It's not something that interests us at all. We are not going to leverage up Berkshire. If we'd leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years.
Part 2 of our video will go through the structure and the amazing trades in his partnership. I hope you enjoyed our video.
We saw long-term capital management where we had